Well, I think the Fed is going to cut rates. I mean, that's pretty clear from the testimony we've had yesterday. Your question is, do they need to do it in terms of stimulating the economy? I would say I think that their concern is you could see this as a rate cut or monetary action to preclude economic weakness. As you mentioned, debt has gone up a lot since the global financial crisis in the last 10 years. What they don't want is people to borrow less. What they don't want is the economy to slow down. And so the monetary changes that they're doing now are to make sure, or to hopefully to preclude a slowdown in terms of the economy. So I think they will cut soon, and I think even if they do cut, whether they do cut or not, the growth worries will persist. So what will happen really is it's the long end, the 10-year of the US yield curve, which is going to be coming down over the next 12 months.
What jumped out to me yesterday was whether the Fed has now strayed into this path of not just being the Federal Reserve for the United States of America, but the Federal Reserve for the rest of the world. And that's been a debate we've had over the last number of years since the financial crisis. And it feels like that was the decision that came through in the testimony, that when they're looking at the weakness in Europe, they're looking at the weakness across some of the EM countries, and they're saying, well, we're going to take action because we're going to shore up world growth.
Right, well, that's a real change. I mean, it used to be, the dictum used to be the dollar is our currency and your problem. Now it's much more that we look at the problems in the rest of the world and we see how they could affect us. So you're right. I think though that what was probably more, what really concerns them more is two things. First of all, very low inflation expectations in the US. And we see those across the world too, very low inflation expectations, but they've been falling in the US. And then the second thing is concerns about whether business investment is beginning to flag. And that's what they definitely don't want to have domestically. Whether it's a question of making money cheaper or whether it's a question of concerns about trade, which will have more of an impact, you could argue the case. But I think that they think, given the tools that they have, maybe making monetary easing would encourage a bit more business investment.
But CapEx is suffering. It is an issue. And yes, this is going to, as you say, perhaps keep the spending at levels where it currently stands, keep borrowing where it stands, not necessarily accelerate it. But ultimately, the uncertainty that is keeping businesses back from investing is out of the Fed's control.
Well, that's correct. I mean, I think you have to have clarity in terms of the trade policy to know what kind of investments to make and where to invest. I mean, you could build the case for saying if you're going to go to a world where we're going to break global supply chains, then there would have to be much, much more investment done within the US. So the numbers that you've been talking about in terms of corporate investment could arguably get a whole lot bigger in the next 5 years if those supply chains have to be brought back to the US.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.